Rockets are flying in the Middle East. In times past, that would have meant the price of oil would have exploded higher. And yet the price of oil, it's up a little bit, but it is still below the average over the past 2 years. So I want to know what is going on. I'm speaking to an expert, a veteran in oil, Paul Sankey of Sankey Research. Paul, great to see you. What is your outlook right now on the price of oil? And I want to get into your secular themes, but also this, brewing tensions in the Middle East, to put it lightly. How severe of a risk do you think that is to the upside? I'm seeing other analysts talk about the price of oil could go to $200. Is that, how realistic do you think that is?
We don't think it's realistic at all because, these problems that we're seeing in the Middle East are part of a long-term pattern, as you know. But that's not the reason why oil is not reacting. There's a huge story here in terms of why prices are not being roiled as much as you might expect by what is a obviously terrible situation in the Middle East. And the biggest one is undoubtedly that the US unconventional revolution has totally changed the dynamics of the global oil market. So if you look back to 2008, which is when oil hit its all-time peak price of just about $150 a barrel, back then the US was importing 13 million barrels of oil a day. If you look at where we are today, after the incredible, as I say, revolution that you had in US unconventional oil, production has absolutely surged up to 13 million barrels a day of oil production. And that's made us actually into net exporters of oil. And so as a result, there's abundant oil supply, and it's well located with, for example, major growth in Guyana, growth in Canada, growth in Brazil, also being obviously Atlantic basin supply that is basically unaffected by the situation in the Middle East. So the supply side is unquestionably strong. And as a result of that, actually, OPEC has been cutting back barrels in order to try and keep prices higher. And as a result, there's significant spare capacity, particularly in Saudi Arabia. And so we see with Saudi Arabia currently producing about 9 million barrels a day, well below the 13 of the US, what we see is a capacity in Saudi of closer to 12 million barrels a day. So in Saudi alone, you have more than enough oil, if it was just down to Saudi, to cover any potential Iranian outage. And then on top of that, China this year has actually gone demand negative, which has been quite the opposite of what we saw in 2008, when China was absolutely booming and sucking in vast amounts of incremental oil. China going growth negative obviously again changes the spare capacity calculation, because now what you're doing is you're actually increasing the cover of spare capacity over demand because demand is falling, and effectively also raising inventories without inventories moving because demand is falling. So for all those reasons, the oil market looks very well supplied. Now, of course, there is some risk that, should Israel attack, say, for example, Karg Island, it would be well over 1 million barrels a day of exports from Iran. But those exports have essentially been tolerated by the Democrats to keep oil prices low. And they aren't actually in the interests of, for example, the Saudis. So there's some potential, I think, for Iran to come out of the market over the next year. The incredible thing is that even then, we still have too much spare capacity, as I outlined, because I only talked about Saudi, and actually there's spare capacity in many of the other countries in OPEC, notably the UAE, where you have, again, a matter of 1 million barrels a day or more of spare capacity. So not anything like the tension that we've seen in the past in the Middle East as relates to what it means for the US.
And so you've been a bear on oil. You think the price of oil is going lower because there's a lot of supply coming online and there's excess capacity, which means if the price goes up, it can instantly be turned on or very, very quickly turned on. And that bearish view that oil prices are going to go lower, that's been working since around Q1. So you were very bearish. Are you slightly less bearish now that these geopolitical Cold War is going on in the Middle East and the Iranian supply could be taken off?
I think one thing that we were talking about on a very widely watched video that I did late last year was talking about the potential for a market share war within OPEC. So in that case, Saudi would actually deliberately increase production in order to crash the price. Everything that we're seeing is that Saudi's not going to do a kick the table over move, so they're not going to flood the market with oil like they did in 2020 or like they did in 2014, because essentially it didn't work when they went for the market share grab. It only served really to massively lower prices, which of course cost Saudi. What they really need to do is get their market share back, and it didn't work in that regard. So everything we're hearing from Saudi, and this is from very good sources, indicates that it's going to be more like an attempt to hold the market together as we drift lower. So I think my extreme downside case is no longer for us as likely to occur as we would have told you a year ago. So it's marginally less bearish, yes.
And what about the upside scenario? I mean, in this business, we never say never, but it sounds like you're very close to saying never on a $200 price of oil. What about a $100 price of oil? Is that realistic?
100 we've done, many times. In fact, we sustained 100, 2010 to 2014 before we ended up with too much US supply the first time around. So 100 is very doable. I think that's definitely within the realms of market. The question obviously being how much does demand react, and ultimately also how much does supply react to very high prices. 200 really seems beyond the realms of possibility, partly because one of the issues here with geopolitical risk is that we openly ask, what else do you think can happen? I mean, is there something incremental that can go wrong at this point? One would be China invading Taiwan. It's not bullish oil. But generally speaking, you've shut the Suez Canal. I mean, I shouldn't laugh about any of these things at all. You've obviously got the Israel-Iran situation, and you've got a land war in Europe involving, what was formerly the biggest oil and gas exporter in the world, pretty much still is, Russia. So all of those things have gone horribly wrong, and we're still struggling along at 70. So the backdrop here is that we're already so elevated in terms of geopolitical tension. I don't know where you can go from here. Could demand surprise to the upside? Yes, but again, you can't push to 200 a barrel. It just, there's too many alternatives, and the transition is on. We've always said the 20th century was driven by oil. The 21st century will be driven by electricity. It'll take 30 years to transition. We're late. We're in 2025, and it's not going as aggressively as we would have thought 10 years ago. The penetration of EVs has obviously been disappointing in the US. You've seen, all sorts of various other reasons why the transition has been delayed. And so essentially the ultimate peak that we're looking for, has not come as quickly as we thought in oil demand. And that's been very positive. Part of the positive has just been sheer population pressure globally, and sheer GDP pressure with all these dollars printed. Strong economies has meant strong demand. But certainly this year, China going negative at the margin, and the fact that a lot of that is secular in terms of alternative fuels for trucks has been the big one over the past 12 months. High penetration of EVs, a strategy clearly to get China off imported oil is all very significant and definitely speaks to the end of the oil age. So without that strong demand, it's very hard to get, even to 150, I would have said. And I can't see a way that we get to 200.
So, Paul, I'm going to ask you the question all oil analysts hate, but they are always asked it. What is your price target for the price of oil, Brent, WTI? You pick, and then where is the distribution of, is it a high confidence 50? Is it a 50, but there's a lot of downside risk to 30? Tell us about your price target and your distribution and why.
Well, I think there's some tactics in all of this. So we've been trying to be bearish relative as well. So we've started raising the spectra of 50 as a point in time target. To give you an idea, if you couldn't have had a worse year than COVID 2020 for oil. I mean, a loss of 20 million barrels a day of demand, and oil averaged 40 that year. Obviously, there was an incredible negative price that was briefly seen in March, April of that year. But essentially, ultimately, we averaged 40. For a year average, I think we're really interested once you get below 60 in how the US E&Ps behave. And our concern is that a lot of this supply growth is not price elastic. So it's going to be tough to shut down a lot of oil production just because the price is below 60. So that would imply we have to go closer to 50. So I think for next year, we're targeting 50 to temper this supply. The other problem is actually demand is not that price elastic. We don't think that people use a whole lot more gasoline in the US at low prices. We think it's more of a sticker shock effect and a sticker shock benefit without being, perhaps as economically important as people think. Obviously, there's some upside with low prices, but it's relatively limited. And elsewhere in places like China, oil demand is very GDP sensitive. So essentially, it's less price elastic and more GDP elastic, if that makes sense. And so with China economic slowdown, it's very possible that lower prices wouldn't encourage demand. So the fact that we're looking at a price inelastic situation here is very worrying, and that's why a point in time target would be for us to hit 50 over the course of 2025. It'll be probably either February as your first target, which is again a seasonal weak point, or by the end of the year, which should get after Labor Day. You know, through driving season, you don't expect lows in oil prices, but in either of the shoulder season, we think that you could get as low as 50.
And so you think that the producers of oil, they've already put in the capital expenditures, the oil's already coming online, and regardless of where the price goes, that's going to be produced. And as the price declines, maybe some people are going to use a little bit more oil, but it's not as elastic, changing to the price. Tell us what you meant about China and just how bad is the economy as measured by oil demand. Presumably in a strong economy, oil demand is very high. In a weak economy, oil demand grows very slowly. And you said that the growth was actually negative, which is very interesting. Tell us about China. What are you seeing there?
Yeah, it's a general weakness that we're seeing basically across the Chinese complex, and ultimately the real-time way we look at this is in refining margins. So you can see that you have very weak refining margins in Asia, and that tells you that demand is weak. Obviously, there can be an element on the supply side, but generally speaking, strong demand won't give you margins as low as they are now, which literally imply that we should be shutting down refineries in Asia because they would be literally losing money. So the Chinese situation in general has been a surprise to everyone this year. People at the beginning of the year were looking for 400,000 barrels a day of growth from China, and that was actually going to be driven by petrochemical feedstocks. They've added a tremendous amount of petchem capacity, and we're actually tracking closer to probably 200,000 barrels a day negative. So we're way off in terms of the flip on what was expected at the margin from China. And by the way, China has remained the biggest driver of the global oil demand growth story over the past couple of years by some way. So it's been the dominant growth driver in demand, which is why the market sold off recently so aggressively in oil, because, I think I was on CNBC saying, if China sneezes, the oil market catches a massive cold. And that's pretty much what we've seen this year. And then, Jack, you're the expert. It's a toss-up as to where you think or at least there's many, many versions of where the Chinese economy goes from here. It's been a really interesting combination of factors that have seen oil go up so much over the past couple of weeks. I mean, a real run that we've had here in oil prices. Obviously, there's the geopolitical situation, but of course, then you had the China stimulus, which was a tremendous kicker. And those two things, which are a very big deal, obviously, in terms of oil markets, particularly China demand and the potential for stimulus to generate more demand that was being feared by the market, came at a time when everyone was so bearish in oil that we actually, for the first time in history, had gone net short in speculative interest. So there's actually a structural level of long speculative interest, which would be things like USO, the oil ETF. It has to hold a position. And for the entire market to have gone net short hasn't been seen in history. And as a result, obviously, we were set up beautifully for a massive short squeeze, which is what we got. You got the China stimulus, you got the geopolitical situation in the Middle East, you got a massive short, and boom, you're off to the races. So we tend to think that this latest action, given that we're skeptical of what's really going to happen in geopolitics in the Middle East as regards whether Israel will actually attack Iran or not in terms of oil infrastructure, which we basically doubt, that would, then give you the China stimulus as the big driver and make both of them transient, if you essentially believe that the Chinese stimulus is not really going to generate real economic growth, not going to have as big a core economic impact as perhaps the Chinese would hope.
Right. I should say what I said in my intro was accurate. The current price of oil at $73 for WTI is below the average of 2022 and 2023, but we have had a bounce over the past week. The price went from $68 to $73, and that is for oil a very strong short-term bounce. But it sounds like you're saying, Paul, you're not a believer, and this short-term bounce is a selling opportunity and not a buying opportunity.
Yeah, I think so. I mean, I don't think anyone wants to short oil into this weekend tonight, which obviously is probably the point of maximum risk of Israel attacking, because we're now getting towards a week since Iran sent the missiles at Israel, to which they, in theory, would be responding. And, we haven't seen anything yet. The key question here is the US election and what the Democrats are saying to the Israelis about the potential to attack Iranian oil infrastructure, and the confusion of the comments that we had from President Biden yesterday, where he basically said they are discussing with Israel the potential to attack Iranian oil infrastructure, and then sort of trailed off, implying that it was too extreme without actually saying that, and leaving the market hanging. But the market absolutely popped yesterday, and into this weekend, I think people will definitely not want to be short. We would see Monday as a selling opportunity. Yeah.
So, Paul, you really are sticking your neck out there, because if the price of oil does spike, goes to $100, $150, this is not going to look all too prescient. And I do appreciate people who make the call that actually the crazy thing isn't going to happen. Rarely, but the tail scenario does happen. But most of the time, the tail risk scenario does not happen. So yeah, Biden's comments, I have the exact thing here from CNBC. He said, when he's asked about Israeli strike on Iranian oil facilities, he said, "We're discussing that. I think that would be a little anyway." And he trailed off, and he said, "Nothing's going to happen today." But he said that they are discussing that. I mean, if Israel does strike at Iranian oil facilities, I understand your point that you think the Paul Sankey Research crude gusher model of the economic price of oil isn't going to go up that much because there's all this spare capacity. Your fundamental analysis, which I'm sure is better than almost anyone's fundamental analysis. But could there be a speculative move higher that could take the shorts off sides?
Yes, and another all-time high, and can you have two all-time highs? Another major high in oil back in '79 was all around attacking tankers in the Arabian Gulf. That was what really caused problems when you were in the Iran-Iraq war. So people are very sensitive about Karg Island because it was very important during the so-called 10-year war. It's a 10-year war between Iran and Iraq, which was ultimately a disaster for oil supply. So there's precedent here, of why it could be a very big deal if Israel were to attack. But more recently, in 2019, we saw the most dramatic attack that we've ever seen in oil terrorism, which was the Houthis attacking the biggest single oil production facility in the world, or at least processing facility in the world at Abqaiq in Saudi Arabia, and actually knocking it out with missiles. And that loss of 7 million barrels a day overnight actually only briefly spiked oil prices, which actually ended, and that was in September 2019, ended that year about the same level as before the attack, which is absolutely incredible. Saudi just about missed no cargoes, despite having 7 million barrels a day knocked out, because they managed it with inventory, they managed it with their triple redundancies. And so ultimately by 6 months later, oil was negative. So the fact that you've seen a 7 million barrel a day loss and get you nowhere near actually even 100 indicates that the loss of Iran here, is not for sure a $200 event. Sorry.
Right, but you don't think that Israel striking oil facilities is different than the Houthis, because the Israeli fighting force have much greater military capacity, so they could mess up way more oil facilities than Houthis, right?
Well, no, they can't mess up more than 7 million barrels a day. I mean, it's not physically possible. That Iran's capacity is not even close to that, let alone their export capacity. The exports from Karg Island are, 1.5 million barrels a day. So that would be that. Of course, the amount of oil that goes through the Straits of Hormuz is a different matter. That's much higher. I'm going to, off the top of my head, I think it's 20 million barrels a day at least. And that would obviously, if you got into the tanker war that I was referencing that we saw in the 70s, then that would be a whole different thing. But of course, your statements about Israel's intentions are very important here, because they're going to have to do whatever they do essentially with American approval. And we for sure know the Democrats want lower oil prices over the next 30 days, if not beyond, depending on whether they win or not. If they don't win, they're going to want higher oil prices, but they're not going to be in power. We do know anyway that Trump says if he wins, he's going to immediately stop, and he said this directly, he's going to immediately stop Iranian exports. So, is it really worth the Israelis' time when they're going to get stopped anyway? And of course, we would assume that I'm sure Saudi wants less Iranian barrels on the market. There hasn't been sanctions imposed against Iran. And that essentially has been, in my view, the Democrats wanting lower prices and therefore turning a blind eye. We've seen the same with Venezuelan exports. So, and of course the SPR releases. So we know the Democrats, despite the so-called despite the environmental agenda, would give preference to low prices, which obviously is internally inconsistent, but it's been a strategy. So we find it difficult to believe that there would be US approval for an Israeli strike right now. On the other hand, it's possible that the Israelis want higher prices, as might the Saudis, in order to facilitate a Trump win. But then you're very much in the realms of conspiracy theories.
Interesting. So it is in the Democrats' interest to have low oil prices to get reelected. So why then is Biden entertaining Israel striking Iran?
That's exactly why oil spiked yesterday, because it's like, wait, what? I mean, that you saw the impact of those whatever it is, 10 words on the oil market. I mean, we went up a good couple of dollars immediately, because it was a total surprise that he would talk about even discussing it. And then, actually the way it was phrased, he sort of said, yeah, we're talking about that, but that's a little implying that, too much or excessive. But then he corrected himself to say anything more and ended just with anyway. So if you read it on paper, it reads very weirdly, but in fact, he just sort of stopped himself. And then the anyway is actually him moving on to some other subject.
Right.
But, just to really parse the words. But of course, the words are so important, and because it's coming from a Democratic president who's an incumbent, it's a very strange thing, because it's like, no, I would have thought given everything you've done over the last 4 years, has essentially been, forget the green agenda, get the oil price down now. It seems extraordinary that just right before the election, you would be spiking the oil price with your comments to the press.
And Paul, how often in your long career has the oil price moved in a completely opposite direction of either your fundamental analysis or the fundamental analysis of analysts who you regard highly? Like, for example, were there people who, made a lot of well-reasoned arguments about a bull case for oil in 2014, but then did the oil price just utterly collapse? And with the benefit of hindsight, we know the reasons why. But I guess, how willing are you to change your mind if the market is not matching your forecast?
Well, I'm tempted to say, when are we not being completely wrong? In fact, what I say, Jack, is I've never been wrong on oil. It's just sometimes my timing is absolutely terrible. No, look, the really interesting thing about oil is, let's say, it's in round numbers, it's 100 million barrel a day oil market. Okay, the price is set literally almost at the marginal 100,000 barrels a day. You can safely say that. I mean, in fact, I've always said that anything above 100,000 barrels a day is material to the global oil market. And the reason for that is the entire market sets at the margin. So essentially what you typically look at as analysts is how much incremental demand growth, absolute barrels, do we have next year? How much supply growth do we have, absolute barrels, next year? And you're talking about, oh no, we're downgrading our demand forecasts. On a 100 million barrel market a day, a big year for demand is 1.5 million, really quite small. And so suddenly you're chopping your marginal 500,000 barrels a day off your demand forecast, let's say because of China. The entire balance changes right there, because oil is a just-in-time, highly efficient, constantly flowing network. And so any interruption at the margin just makes the whole system, go nuts. And we saw this in the other direction with negative prices during COVID, when there was simply nowhere to put all this oil. And so the price goes negative because, you have to you have to pay someone to get rid of it for you, basically. So with such a fine balance, between supply and demand at any given time, you can be absolutely spectacularly wrong. But we've seen, as I said, things like Abcake that give us parameters for the market, right? So we saw what happens in a 7 million barrel a day outage, and frankly, it wasn't very impressive. With Russia, again, you had a huge fear at the time of the invasion, obviously, that you'd interrupt all Russian oil exports, etc. And again, you got to maybe, 120, 130 at a push, and that was it, and of course the market then corrects very rapidly. But this marginal aspect to it all is very important in understanding why we can be just completely wrong at any given time, because the balance can change, over the course of a year just so dramatically.
But if the marginal barrels that are setting the price is $100,000, say $80 oil, that's $80 million. There are hedge funds, commodity trading hedge funds, that are much larger than that, just one single hedge fund. So is it very speculative? And, with the benefit of hindsight, don't we know that 2022, the $120, $130 barrel of oil never really was rational, and that it perhaps was speculators and hedge funds pushing the price higher than the true economic value, given that Russia really did not come offline as was anticipated?
Yeah, the interesting thing about the speculative side of the market is that it's very highly concentrated in the next 2 months. That's where all the open interest is. And you can see this, it's public data. And then, the third month even is a major step down. And then when you're 12 months out, there's very little, actually relatively little liquidity. And over the past 20 years, we had urged the oil companies not to hedge as a way of getting them to recognize that they shouldn't be defending a strategy that doesn't work at low prices. So we're saying don't hedge yourself, because if the oil price goes up, that's why we own your stocks. And if it goes down, it means that you keep up activity when you shouldn't be. So stop that. But to go back to the original point, all the open interest in the speculative market is very short term. And that's why you get, for example, this big move that we had recently upwards in the near term. And then we look at the shape of the curve, although it's always something of a smear in terms of not much liquidity further out down the line. So less accuracy, if you want, less market information being expressed further out. And that's, for example, at the moment, we've been dropping at the front whilst holding the back, essentially flattening the curve. And what we would expect to happen over the next year in a bear market would be for us to go into contango and actually see current prices below future prices. For the past 2 or 3 years, we've consistently had current prices in the liquid part of the market much higher than what the market's prepared to pay in the future, which is typically seen as an example of a tight market. And that tightness has really been created by Saudi not producing the incremental 1 million barrels a day that they currently have off the market, which has served to, give you that extra $10, $15, $20 a barrel that you've seen on the price over these past couple of years. They want to bring that oil back, and that's another reason. The desire of OPEC to actually produce more is another key reason, even though if you look at the incremental barrels, they're not that great in terms of what they're saying they'll do. In reality, because of that 100,000 barrel a day globally significant number I spoke of that effectively does set prices, it's a lot of oil in that regard, and that's another reason why people are bearish. The other thing that's worth highlighting is that within the core of OPEC, the two key members were Saudi and UAE, and they absolutely acted in lockstep. And after just the past couple of years, the UAE has begun to get frustrated about having to cut back so much production capacity and carry spare capacity, which is extremely expensive. Obviously you've got to maintain it, you've got to keep it in good shape and ready to produce, but you're not making any revenue from it. And so with such a small population in the UAE, United Arab Emirates, they're going, you've got so much oil reserves. I don't know why we would sit on this oil if the oil age is actually ending, as we've been, I've been saying for 20 or 30 years. It takes a long time to end the oil age, but it is ending. And as a result, UAE has genuine concerns that they don't want to hold back production unproduced because it may never get produced. And that's another enormous tension when you think about it being at the center of OPEC dynamics, that Saudi and UAE used to be so close. You now have Saudi increasingly isolated.
Right. So there's an article from the Financial Times, came out a week or two ago. Saudi Arabia ready to abandon a $100 crude target to take back market share. The oil price falls as the kingdom prepares to raise output from December. So you're saying that Saudi Arabia, a key member of OPEC, had been limiting supply to increase the price, but now they're saying, hey, if oil is only going to be here till 2050 and we've got 50 years of reserve life, it doesn't matter if we can make the price higher. We can't do what we did in 1970s anymore because the time is ticking. We need to pump this oil now. And you're saying the UAE is doing the same thing.
Yeah, basically. I mean, Jack, let's go in the equivalent of inside baseball a bit here on that FT story. There's a number of things that were interesting about it. The first is that in the first line, they said Saudi's going to abandon its unofficial price target of 100. That's a very odd number to oil analysts, because they've said in the past they would like to see oil at 95, but really not 100, because it's such a psychologically sort of negative price for consumers. So they want to go sort of as close to 100, but not 100. So they've never really had, they say they don't have a price target, but nor have they had an unofficial price target. And if they did, it would be 95, not 100. So that was the first odd thing. The second thing is that the current Saudi oil minister, Abdulaziz bin Salman, Prince Abdulaziz bin Salman, has had a contentious relationship with the press. And it's become important for OPEC meetings as well, actually, which are now much less held in person. But in the past, it was a real press jamboree. People got a nice trip to Vienna, and all the oil ministers loved it. But it developed this contentious relationship between the prince and the press, which manifested itself a couple of years ago with a pretty unhappy situation with the prince regarding Reuters, who he accused of false reporting or whatever. There's also been issues with Bloomberg, which has, as you probably know, a very green agenda through Mike Bloomberg's own personal interests, and so sort of an anti-oil agenda, if you want, or at least a perceived one. And then actually, ultimately, there's also been problems with the Wall Street Journal. So the fact that this story was in the FT, even if it rang a little bit weird, there was definitely speculation that this was potentially Saudi using the FT as a mouthpiece. And so it was taken quite seriously that probably they were floating the trial balloon into the market through the FT, because the FT journalist is a new journalist, and so that doesn't have any of the history of the other guys. Whether or not they were actually floating a trial balloon to see what the market reaction would be. That's triple thinking, inside baseball stuff. But you asked me about the story. Yes, the answer is, in terms of, would that mean, that they're going to actually go for market share and not try and hold the market together any further? I think de facto the issue is, because they're already at 9 million barrels a day, their choice is, do you want to go even lower? Do you want to go 8 million barrels a day? At one point in the 80s, Saudi went down to under 3 million barrels a day, same capacity as today, in order to try and prop the price up. And so, are they prepared to do that? I think everybody's agreed that Saudi is not going lower than 9. And the question is, would they actually sort of accelerate the whole process by increasing production, or will they sort of just let it bleed lower? And I think most people now really firmly believe, and I referenced earlier, that they're not going to kick the table over. They're just going to have to watch the oil price bleed lower. At that point, it's going to become a question of how much longer do the US exploration and production companies keep spending. And the problem for Saudi, going back to the price elasticity issue, is that Exxon, Chevron, Conoco, all very strong US E&Ps, and that in the past, US E&Ps weren't called things like Exxon. And these guys are not going to back off at lower prices, because they've got mega projects going on in the Permian as much as they do in Guyana. So lower prices may not cause a significant cut in spending at those big guys. It then falls to the smaller guys to be forced to cut spending. And that's a very difficult decision for them once they're already at flat. So at the moment, they're essentially all saying, we're going to hold flat at a given level of relatively low capex. We're not going to try and grow. But the decision to go into decline, for the board to sit there at the company and go, actually, okay, let's start declining the company, is a whole different step. And so that's why we talk about the $50 price, because we know these guys are really planning at 60 to 70. You have to go well below that planning assumption to really get them to change behavior. Another problem for Saudi, the balance sheets of these oils led by Exxon are outstanding. In the past, you had basically a bit of a bunch of yahoos in the US E&P industry, very much a wildcatters kind of vibe about them. And of course, they all carried huge amounts of debt. Now, many of these balance sheets are absolutely pristine amongst these big US E&Ps. And so they're very much more resistant to low prices. It could be a battle, because Saudi hasn't borrowed that much money either. Compared to Japan or the US, Saudi effectively has no debt. So, it's going to be an interesting couple of years. I wish it was more bullish.
So the growth in oil production supply has been mostly in the US, Guyana, other places, but not Saudi Arabia. Saudi Arabia has been keeping the lids very tight. And you're saying that the production in the US, the remarkable growth in production, which, by the way, it's interesting that occurred during a Democratic administration, because there's a narrative that Democrats hate oil and they're not even allowing companies to drill. The data belies that, as you know. But you're saying that the shale companies they're not going to go bankrupt anymore like they did in 2014, because they're Exxon. Exxon is not going bankrupt at $40 or even $30. And so the production is not going to stop. Paul, what about this narrative of oil companies saying we have shareholder discipline? The time when we borrow $1 billion and go bankrupt in order to produce as much oil as possible, that is long gone. We now have shareholder discipline. We're buying back stock. We're paying back debt, and we're issuing dividends. We don't care about drilling. We just care about making money. Does the data of the remarkable growth in Permian production, shale oil production, indicate that narrative was just that, a narrative, and not true?
No, not at all. They absolutely did it. I mean, they got the memo. It took them a while. We started really arguing. We wrote a note called The Renaissance of US E&P in 2017, where we said, I mentioned stop hedging, stop spending so much money, generate some returns to shareholders. How's about that for an idea? And they all said, yeah, we get it in 2017. But as soon as the oil price started going up into 2018, they all raised their capex again, and the group got thrashed by the market. This time with COVID, they had no choice. They had to do the massive capex cutback or they were gone. So they either sold themselves or they really got the memo, and they really have changed their behavior. And really, 21, 22, particularly 23 to some extent, they made terrific returns. These guys through, almost across the business have been making in excess of 10% return on capital employed, which, might sound terrible to an NVIDIA shareholder, but in reality is actually, a double-digit return. If you return that to the shareholders, compounded is an excellent return. So they've really done a good job. It's just this question of can they keep it up and actually voluntarily go into decline, perhaps by saying, well, we're going to buy back so much stock that for shareholders, production will stay flat because we're going to maintain free cash flow. It's just not very credible into a falling oil price, but it's actually what they have to do. So they have to say, okay, yeah, we're going to take the declines in volumes because we're going to get the capex down to a free cash flow generating number, and then we're going to give it back to you as continuation of dividend. It's again, it's going to be interesting to see who gets that right and who gets that wrong. But yeah, essentially, capital discipline has been a theme of the industry, and it's going to be interesting to see if they somewhat lose that at low prices. If they can't really push through the model to its logical conclusion, which is you have to cut and you have to go into decline when prices are going towards 50.
Thank you, Paul. And so if companies have been disciplined with capital, they haven't been spending money, how come U.S. oil production has gone up so much? Where are they getting this money to finance it?
Well, I'll give you a really long answer to this one because it's kind of interesting. But if you look at the long-term cycle of oil prices, it's actually set by the key word here, productivity. So obviously what you're looking at is improved productivity. And if you think about, what they're saying about AI, people always say to me, what do you think AI's impact is going to be on Wall Street research? And I say, I'll tell you what it's going to be. It's happened to me over the last 20 years. I know AI absolutely wrecked, and of course I'm talking about computing in general, absolutely wrecked the business of the sell-side analyst because, you went from writing a letter to your stockbroker in order to trade a stock and paying him a huge commission for that pleasure to trading, huge amounts of E-Trade out of money, on the day expiry, options for almost nothing. And that commission is what used to pay the analysts. So, my business has been absolutely thrashed by AI. And by the same token, productivity in oil has been remarkably improved, particularly the drainage of the reservoirs, understanding the reservoirs. We were talking about EOG as the apple of oil in 2017, 2016. They were using what they called big data. Oil industry is actually cutting edge technology for this stuff. In fact, EOG at the time said that they felt they were ahead of Silicon Valley in terms of their use of data. This is stuff like landing a drill bit a mile down and 2 miles along within 5 feet of where you want it to be. You need a lot of computing power to do that, and they've absolutely employed it. So the long answer is it's productivity improvements that you are just getting better at producing oil. And you can see that because we didn't think you could produce enough oil to have a 100 million barrel a day oil market. We thought the constraining factor would be you just can't supply 100 million a day. And the Total CEO, the legendary Christophe de Margerie, was always a big arguer that there simply wasn't the resource. This was the peak oil era of the 2000 to 2010. We simply couldn't meet, future China demand, etc. In reality, the US Revolution, which was very simple but remarkable, which essentially combined two established technologies. One was horizontal drilling, which was established, and one was fracking. Combining the two released the source rock and therefore the ability to produce way more oil that you thought previously was trapped by low porosity. And as a result, what we saw was the US Revolution, which has been absolutely remarkable. And that was the difference. The incremental 10 million barrels a day that you got from the US essentially is what allowed the market to get up to excess supply at 100 million barrels a day. So we have too much supply, even though we're at 100 is absolutely remarkable. And, it's a long answer to your question that the answer is productivity. Now, if you look at the bull cycles in oil, productivity sets the oil price. So what happened with the formation of OPEC is you effectively cut productivity, price went up. As a result of the price going up, you developed non-OPEC, which at the time was North Sea, Alaska, and productivity came down, the oil price came down, and so on and so forth, until ultimately you had massive gains in productivity in that US unconventional boom. And that's essentially what was allowed the market to get so big at relatively reasonable prices. Because in reality, in energy density terms and energy calorific terms, oil remains very cheap.
Right, got it. And so if I'm looking, and I am looking at a chart of the U.S. oil production decline from 1980 to 2005, the remarkable rise in oil production from 2010 to 2014, we could say that was very capital intensive. That was the day of, what is his name, Aubrey McClendon, borrowing bunches of money on Wall Street, private equity, all this, burned, wasted capital into the ground. Shareholder returns were horrible. You're saying that the more recent rise in oil has not been reliant on financing. It's been financed by technological improvements in productivity, and I guess companies have been financing themselves from their own profits, maybe.
Yeah. I mean, they got better. They got better at getting the oil out of the ground. I mean, none of these guys, U.S. oil and gas production essentially declined for 30 years in a straight line. And the peak of that declining productivity was very much that period that you just referenced, 2000, 2008, when the oil price went crazy. And it felt like we were stamping our foot on the accelerator. We had huge excess cash flow in the industry, but they couldn't generate any growth. And they went into a major phase of trying to invest in things like Canadian heavy oil sands and exploration and huge LNG projects that all had huge cost overruns and really didn't produce. They were declining productivity essentially until you got that horizontal drilling and fracking boom that really was nothing in 2010, to kind of 10 million barrels a day in 2020. Absolutely stunning. And that was obviously a massive productivity gain that ultimately has been quite bearish for the oil price. You had external events, which were effectively productivity losses because Russia invaded Ukraine, which took a huge amount, at least challenged the market in a very big way. There was a knock-on effect because of the interruption to Russian gas, which was very real into Europe, and that boomed out oil demand in Europe and globally for distillate as well. So all those things conspired, to be other factors. But the bottom line is, over the years, you can see that productivity is the key. And these companies are doing a very good job of productivity, essentially using technology.
Right. And so when people use the phrase peak oil, that was the peak in supply for oil. And it's often a very doomeristic or doom-inducing word, because the world cannot produce the oil that the world needs, and so that have horrible economic consequences. It sounds like you think there will be the demand for oil is going to peak far before the supply for oil. So two questions, when do you think the demand for oil is going to peak? And then also, what is peak oil supply in the world and then in the US? Because again, we went from 2007, 5 million barrels a day to now we're almost at 14 million barrels a day.
Yeah, absolutely. The peak demand is an interesting one. I think our view has always been that we have a long plateau, because obviously as demand comes up and the price comes down, you should offset that obviously through encouraging more demand to be sustained than you would otherwise have been. So the other issue here is definitely population pressure globally. So the bull argument for demand being nowhere near a peak is essentially population and GDP growth, and that's reasonable. The difficulty is really understanding how well the energy transition comes through the market, because, for example, this year we've seen China definitely surprised to the upside on how much it's been able to continue growing its economy. Because, as you know, Jack, China now talking about maybe 5% GDP growth as a sort of ongoing run rate. Oil demand, I told you, has actually gone negative. So you can see right there. Or, for example, if you think about the boom in the US economy with more or less flat oil demand, you can see clearly that the GDP intensity is falling. And as I said, it's more about GDP intensity than it is price intensity. So, peak oil demand, I think our argument has always been long plateau with, some cyclical, down years in between all that. And I think what we're worrying about here is the cyclical downturn. And we're as fascinated as anyone about the whole debate on US soft landing and everything else, because there's so much knock-on effect there that, it really makes the difference between oil demand rising and falling. You can't deny that the secular trends, which bullish on the population side, but bearish on the energy transition side, is why you get to a long plateau, before it really falls off. If I had an hour, I'd get into discussing the whale oil market with you, which we had talked about previously in peak oil terms, because whale oil simply, the price peaked when the market peaked, which I always found interesting. So in the 2000s, when people talked about oil supply, they always argued that the oil price would then go to the famous 200. But if you look at whale oil markets, when supply peaked, actually the price peaked. And interestingly, even though whale oil followed a perfect Hubbert's peak, so a perfect decline curve, the price of whale oil, believe it or not, actually fell with the market. And so to us, everyone was looking at that whole peak oil excitement in the 2000s completely wrong-headedly, admittedly, partly because we were using the example of whale oil, but it seemed kind of clever to us. But I have to say, these Permian projects for Exxon, this Guyana, Canada, Brazil, these all have years of supply growth ahead of them, which really are dependent on how much money is put into them. There's no geologic limit in the way that people argued with the peak oil arguments in the 2000s. That was totally wrong-headed. And by the way, one of the key call-outs there was that Saudi was going to run out of oil, and Saudi just didn't even come close to running out of oil over the last 10 or 15 years.
All right, so Paul, you're bearish on the price of oil. You think it could go as low as $50. How is that? What are your clients at Sankey Research, many of whom are very sophisticated institutional investors? What advice are you giving to them if they own a big slug of Exxon, Chevron? I presume they want to continue to have their hydrocarbon exposure, but are you saying get out of the small cap crappy oil companies and go up into quality? Are you saying go up to Canada? Are you getting into Petrobras, offshore, the pipelines? How are you sort of playing this, and what advice are you saying?
Well, the facetious answer is we're recommending utilities. But actually, if you look at utilities relative, they're very interesting because really, they haven't done a whole lot for many, many years. Deeply boring sector, regulated, no demand growth. And no demand growth, obviously, is the key. And now we have a real story here with these big AI Mag 7 companies pursuing. We were just hearing about Elon buying 1,200 acres in, I think, Texas in order to build a data center next to a major power plant. So, that theme is huge. On the oil side, it is a bit of a struggle. And unfortunately, a lot of investors are really not interested. And all this OPEC chat, all this double guessing, what did Joe Biden say to who about, Israel, Iran? Long-only portfolio managers just don't want to know. It's like, as you said, oil analysts are almost invariably wrong at some point, and there's just it's not capitalizable, so much of this volatility, right? So you'll see stuff bounce around, but you won't see any great structural improvement in valuation. Exxon, we love actually at the moment. We've got a big analyst meeting coming up for Exxon on December the 11th, where I think they'll outline significant volume growth, as Total did last week. They upgraded their volume target, just adding to this theme. Total, excellent company. Exxon, really, again, a super defensive, but really importantly, Exxon is the last truly integrated major oil. So it's the last big oil that actually produces, refines chemicals right through the chain and sells the equity barrel at the end. And that's a remarkable achievement from the company, which has really transformed itself over the past 5 years very impressively. But of course, I'm talking a very defensive name. And there's an old joke of mine, which is if you're bullish oil, why would you buy Exxon? Because obviously you'd buy the more levered stuff. If you're bearish oil, why would you buy Exxon? Because obviously you'd go out and buy Tesla or something. So it's a tough one, but it's structurally really looking good at the moment, Exxon, and we're pretty excited into this analyst meeting. For the rest, one area that might be interesting is refining, because obviously if you've got too much crude oil, but demand remains relatively strong, which it is because of the strength of the global economy, then ostensibly refining would be in a good place. And refiners want more OPEC barrels because they're heavier, sourer, and make their margins better from more complex refiners such as PBF. But seasonally, this is a difficult time to be buying refining. Guess what? We're actually bearish US natural gas as well. But the stocks there look, well supported by multiple expansion because they become thematic, however optimistic on the AI theme, because everyone realizes that once you've signed up all the spare nuclear capacity in the US, which you're doing very, very quickly, and that's what's fascinating about the AI theme, is it's moving so fast. But what you're seeing is the spare nuclear capacity is being signed up because it's low emission, big scale production, which is and base load, which is what's wanted. If the next leg of base load power supply really has to be natural gas, it's pretty much the only choice for base load. And as a result, people are very bullish on the secular story for US natural gas, as well as the potential for LNG exports that we referenced earlier. So natural gas demand in the US looks very strong. The problem is there's a massive excess supply, but as of yet, the market is looking through that because it just wants to be long this mega theme. For us, we're not convinced. We think 25 is going to be a rough year for natural gas, and we would rather wait. The stocks have also massively outperformed the commodities. So again, if anything, we're somewhat bearish on those guys, particularly if, as always seems to be the pattern now, we get another warm winter, which is really where the majority of the gas balances out. So that leaves you with offshore service, onshore service. We don't like onshore because we think you need less activity in the US, but we do think that the Saudis, regardless of the oil price, will keep spending on their mega projects, and others in the Middle East will keep spending. So for us, Schlumberger, Baker Hughes, Schlumberger's been really beaten up, would be pretty good places to be counterintuitively, even into a low oil price, because of that international spending that will continue. Amongst the E&Ps versus big integrated oils, some of the stuff we just really like the management. A good example would be Diamondback. You know, I'm quite happy to give them my dollar, figuratively. You know, I must stress figuratively, in terms of my belief in their ability to add value over time. And you know, there's a couple of other E&P names where, as you see in the research, we really appreciate the management and the strategy. One that's historically been good, but perhaps struggled a bit in terms of loss of multiple, has actually been EOG, which is another good name. Now, on the downside, some of the more levered names, you know, they're well known and they've been pretty beaten up, so we don't probably need to beat them up more. But there's plenty of stuff that's really not going to do well if we go to 50. That's for sure. Pretty much anything in the energy group, you know, in the E&P group is going to struggle, particularly if gas is also under pressure.
And do you think that there will be bankruptcies at $50 oil?
We'd have to look at the burn because the balance sheets are good. So no, that's one of the points about being so bearish, is that actually the industry is in such robust balance sheet shape that I think it's more likely that what happens is you get more M&A. You know, that companies, and we've seen this very much, is as they lose strategic outlets, as they got to go into decline, the obvious thing to do is to merge. And for example, in the past week, there's been reported Coterra for OVV, for Vintiv, would be, you know, the classic sort of, you know, these guys are going to find it very tough unless they, you know, synergy up and, you know, really get defensive in terms of what they're doing. And the easy thing for the management to do in such a tough outlook is to sell yourself. So I think M&A could be definitely a theme amongst these middle rank guys that aren't going to do well at all if we hit to 50. So
you like refining. An example of that would be Marathon.
Relatively speaking, yeah, Marathon's doing fantastically. I mean, be careful though, because at the moment refining margins frankly suck, and you know, we've got to work that through. The earnings estimates have come down, and you need to start shutting down refining in Asia in order to rally the margins. We think that you're towards the bottom of how low margins can go, but you know, seasonally it's a tough time to get really excited about refining. Our argument is more, relatively speaking, we would prefer, you know, to be long refining, short E&P. And some of the
because
clients,
as the price of oil goes down, margins will improve because an input is oil.
Yeah. Especially if we got the soft landing type scenario where demand holds up. You do not, under any circumstances, want to own a refiner into bad demand, which is why seasonally I get itchy about saying buy them, you know, here in September, October, because obviously demand falls until winter starts. A driving season to winter is what we call a shoulder season. And you know, it's tough to love refining when demand is falling and there's too much supply, which is essentially what we have. But if we get to a situation where margins are so low, the Asians start shutting down capacity, and we go into winter, that's when you think, yeah, I want to be long refining. And relatively, we definitely prefer it because of what you're saying, that the oil price goes down, bad for E&Ps, good for refining.
What about Chevron, and what about Hess, which I believe Chevron has acquired or is in the process of acquiring?
Definitely hasn't acquired it. It's tried to acquire it, that's for sure. We love the Chevron management. They're terrific. Mike Wirth is, you know, really one of the easily the most charismatic major oil CEO, with all due respect to the other guys. Actually, Ryan Lance does a great job of charisma. Hey, throw him in there. Darren Woods has his own charisma, very definitely. Very, you know, the Exxon CEO, absolutely. So no, but you know, without being too ridiculous, Mike Wirth is very impressive. They've got a major startup in Kazakhstan, which kind of worries me. But the big overhang, as you reference, is that they tried to buy Hess. They had a bid off. They had a bid accepted. The FTC has approved it on the proviso that John Hess is not on the board because of, you know, previous OPEC dinners or you know, whatever the FTC thinks the problem is. But there is a major issue, which is that they've had to go to arbitration over the Guyana asset because of the nature of the contract. And Exxon, we think, has been actually deliberately spoiling the party for Chevron. if Chevron buys Hess, they become very similar in upstream to Exxon, and we don't think Exxon really wants them to be in that position. So I think they're playing a little bit of a spoiler here, to say the least. And what's happened here is that the arbitration decision on exactly the nature of how Chevron buys Hess and what Exxon is entitled to in that process, if anything, that's not going to be decided until 3Q next year, believe it or not. And so everybody who was all excited about Chevron Hess has sort of wandered away, talking about the merger arb guys and stuff, because the situation is just going to drag on. There's really going to be no resolution until next third quarter. In the meantime, the Kazakh project has to start up. It's already over budget. It's already delayed. And of course, now it's in Kazakhstan, which doesn't seem as clever as it did before Russia invaded Ukraine, to say the least. So that we think that there's quite a lot of geopolitical risk around those barrels as well. And so, Chevron's a bit tougher. Chevron also has less refining and chemicals than Exxon, for example. And so, in that E&P scenario, it's more of an E&P. Even more an E&P would be ConocoPhillips, who have relatively high capex, doing a great job, generally speaking, really outstanding company, but not one that would particularly excite us into a falling oil price environment.
E&P is exploration and production, so just upstream. But Paul, don't people say that Hess has a lot of people like Hess because it has refining exposure, or is that not true?
No, that's wrong. They essentially, activists came in and had them sell the refining and the marketing, which would be the gas stations and the toy trucks and all that stuff. The toy trucks survived, to everyone's delight, but they came under activist pressure through 2013 onwards and actually rationalized out all refining and downstream, essentially. And then, what was it, 16, 17, the whole Guyana story became the best, most valuable asset in global oil. Totally remarkable, discovery, totally stunning. And Hess is by far the most levered to that. And now they're being taken over. People like Hess here, essentially, I think there's a bid from Chevron. So you have to know your ratios and where Hess is relative to the offer. And it's pretty cheap relative to the offer. So if you're convinced that the arbitration will be won, and Hess tells you it will be, and Chevron tells you it will be, Exxon doesn't comment. But if you really believe, which broadly speaking we do, that Chevron will win the arbitration, then Hess, certainly you can short Chevron on the other side if you want to get really complicated. But Hess, I think generally speaking, we consider it to be undervalued here. The problem is, obviously, if you buy Hess today, you're essentially buying a Chevron share, and you just have to look at the spread between the two and decide whether you think you're getting enough of a premium, for effectively owning Chevron on the cheap would be how to look at it.
Thank you, Paul. Final question on asset allocation is, if you think the price is going to 50, why are you not wildly bearish on offshore, drilling in the ocean? I thought that offshore was one of the most expensive, highest break-even costs, that, they don't make money unless it's $60, $70, $80. So if the price is at 50, why would people be, employing companies like Noble or Valaris or Seadrill and the like?
Well, because what we're talking about is international versus US. So what I'm talking about is Saudi gas projects, for example, which, Baker Hughes LNG spending is going to keep coming. So those are the international Middle East, basically Middle East, call it. That spending we think will be sustained because these are major secular structural projects that, for example, Saudi is doing a massive gas development because they've really not used as much gas as they should, and they still burn oil for power generation. In fact, Saudi's gas plans are going to release, guess what, another 1 million barrels a day of exports for Saudi by, I think, 2027. So again, it's an example of where the spending's going to hold up. So you like the internationals. And again, a lot of these calls are relative, so compared to what we think will happen with US activity, Middle East activity is going to stay very high. For the pure offshore that you're referring to, the Noble, the Rig, Diamond, Transocean, those guys in a falling oil price, it's going to be tough, even if they've got great contracts in Brazil and other reasons to argue. The way the market will trade them is, oil's going to 50, get out of rig.
Thank you, Paul. My final question is about AI. People are talking a lot about how data centers are going to use so much electricity, and this is a bull market in natural gas. How much do you buy this? And what are your thoughts?
We buy it. I mean, I think that, just based on oil experience and general observation, without pretending to be a tech analyst, whenever we see CapEx get as high as it's being cranked by the Magnificent Seven companies, where they're in an arms race, there's probably corporate ego involved here, which is super dangerous. We think that, there's going to be at least 2 or 3 major losers from this, Who knows? Maybe all these AI machines work together. But I tell you, I just got myself a new Microsoft Surface Pro, and getting it to speak between Google, Apple, Microsoft, and everyone else that's fighting is just so difficult. So there's definitely some corporate ego in this capex binge that's going on, and a fear of missing out. And we think that will be very disappointing for at least some of the companies involved here. So you're going to torch a lot of money. But the scale of these companies and balance sheets, financial capacity is so big that we think they're going to be doing this spending for at least 2 to 3 years, and until it's demonstrably failed, and they really don't know where they're going with AI. So it's going to be a long time before you can say, yeah, didn't happen, or with upside, it did. So really what you're looking at here is fascinating, is this enormous surge in demand for electricity in the US, which we really haven't seen for 10 or 15 years. With no effort, most people use less electricity over the last 10 years because they bought a new refrigerator or, a new TV, which are far more power efficient. So this industry, the utility industry, hasn't faced strong power demand almost in its history, or at least in the careers of those who work in it. And now you've got, AI companies showing up saying they want 1,000 megawatts. 1,000 megawatts is a major nuclear plant of electricity just to power a data center. I mean, it's insane. That's why, frankly, us oil guys are all like edging over towards the utilities guys, because it's going to be a thing for a while to come. And the oil outlook, as you can tell from this presentation, from my point of view, is pretty tough here for a good couple of years.
And Paul, do a lot of oil analysts share your somewhat pessimistic view on oil, or are you in the minority?
No, this is basic addition or subtraction. So yeah, if you're doing the balances, there's a problem, and you actually just get into reasons why the balances could be wrong. But these are big lumps of supply and demand here, and it's pretty incontrovertible. A lot of it is long cycle. So once you've invested in Guyana, for example, the Guyana barrels, it's Exxon. They're going to show up next year. They're going to grow like a weed. Do you think that won't happen? There's reasons why it might not, but it's a tough call. And by the same token, probably the single biggest risk is actually on demand. That's where we can be really wrong at times, especially when I said to you that, for example, China is growing at 300,000 or 400,000 barrels a day, assumed this year, and actually shows up negative. We're as likely to get surprised to the downside in demand, probably more so almost than we are on supply, with the exception of whatever Saudi does next. And if we think Saudi's not going to cut below 9, we kind of know that Saudi's either going to stay flat or, hope to go higher. So, there's not that many outcomes. There's only about 10 or 15 moving parts here in global oil.
Thank you, Paul. It's been fantastic getting a chance to interview you. People can find you on Twitter at the great handle @CrudeGusher. You have a YouTube channel, Paul Sankey, people should check out. Tell us about what clients get with Sankey Research and where people can find you.
Well, that's Sankey Research institutional product. So it's designed, frankly, and priced for hedge funds and for major long only investors. If you're really nice and you're demonstrably retail, we can probably offer you a subscription. You can just email me, paul@sankeyresearch.com. If you really don't want to spend any money, the YouTube channel is now, and it will be for a while, I would think, Jack, based on the number of views I'm getting, it'll probably stay free for a while. I think I've got a long way to go before we start harassing people with adverts on that. So if you just want to tune in occasionally, the YouTube channel is free. If you want to get into buying the research, we can set you up to talk to sales and everyone else, but just be aware that, it's priced at an institutional level. But if you're super nice and you're obviously retail, we can talk about a retail subscription.
Thank you, Paul. Thank you, everyone, for watching. Remember to subscribe to Monetary Matters on your favorite podcast apps, whether it's Apple Podcast or Spotify. And of course, we are on YouTube at Monetary Matters with Jack Farley. Have a great weekend, everybody.